Right now in Singapore, someone in their early 30s is sitting at the kitchen table after a long day, phone in hand, looking at their CPF statement. The number on the screen has just crossed $100,000. They feel a small wave of relief. On the same evening, someone in their early 50s is looking at a total balance that is still hovering under $300,000 and quietly wondering whether they will ever feel truly secure when they stop working. Both of those situations are completely real in 2026. Today, we are going to walk through the actual numbers from the CPF Board and show you exactly when most Singaporeans hit $100,000, $500,000, and $1 million in their CPF. We will use the latest official data. We will look at what those balances actually buy you through CPF LIFE, and we will be honest about the traps that stop many people from reaching real retirement security, even when the headline number looks decent. Let us start with the first milestone that matters, $100,000. According to the most recent CPF Board figures, as at the end of 2025, the average member aged 30 to 35 already sits at around $114,000. For many people in that age bracket, the six-figure mark arrives sometime in their early to mid-30s. The median is often a little lower, but the data shows that crossing 100,000 is no longer unusual once you are past 30. At this level, you have cleared the first psychological and financial hurdle. Compounding starts to feel real instead of theoretical. Yet even here, the picture is not as simple as it looks. A large part of that balance may still sit in the ordinary account and could be used for housing later. Many Singaporeans in their 30s are still deciding how aggressively to pay down their HDB loan or whether to upgrade. Every dollar that leaves the CPF for property is a dollar that stops earning the higher interest rates available in the special or retirement account. So while $100,000 is a genuine achievement, it is also the point where small decisions about housing and account allocation begin to compound for decades. Move forward to the late 30s and early 40s, and the average balance rises further. By the time most people reach the 35 to 40 age group, the average sits closer to $161,000. The 40 to 45 group averages around $214,000. These are solid numbers on paper. They reflect 37% total contributions for those under 55, the power of compounding at CPF interest rates, and the extra 1% or 2% the government adds on the first $60,000 of combined balances. Yet this is also the stage where lifestyle creep and housing decisions start to bite hardest for many. Upgrading to a larger flat, taking a longer loan, or using CPF for a private property purchase can feel like progress. In reality, it often means a bigger portion of future contributions and interest is locked into an illiquid asset. The people who pull ahead here are usually the ones who keep their housing costs reasonable relative to income, and who regularly move surplus ordinary account money into the special account to capture the higher 4% floor rate. Even a transfer of $10,000 or $20,000 at age 35 can grow into a noticeably larger difference by 65 because of that extra interest and the longer compounding period. By the time we reach the 50 to 55 age group, the average CPF balance climbs to around $315,000, according to the latest detailed breakdown. This is the point where many Singaporeans begin to think seriously about retirement. It is also the point where the gap between average and median becomes more visible. The people at the higher end of the distribution have often had consistent full-time careers, lower housing withdrawals relative to their income, and perhaps some voluntary top-ups along the way. The median person in this age band is typically lower. A significant number are still below $300,000 even at 55. Part of the reason is structural. Women on average have lower balances than men in the older groups, largely because of career breaks for caregiving, more part-time work, and lower average earnings across many industries. The system does not treat everyone the same once real life intervenes. Another major factor is housing. Many Singaporeans have used substantial amounts from their ordinary account for HDB flats over the years. That money helped them own a roof over their heads, which is valuable. But it also means less capital has been growing at the higher special and retirement account rates for retirement income. At 55, you can choose to set aside only the basic retirement sum in cash if you own a property with a sufficiently long lease, and withdraw more from the retirement account. That flexibility exists for a reason, yet it also means some people arrive at 55 with a lower cash retirement sum than their total CPF statement suggests. This brings us to the larger milestones: $500,000 and $1 million. These numbers are where the story changes from comfortable progress to genuine financial optionality for most people. Reaching $500,000 in total CPF balance by retirement age is still not the experience of the meaty and Singaporean. The averages we looked at earlier show that even at 50 to 55, the typical balance is well below $500,000. Only those who have maintained high contributions for decades, minimized early housing withdrawals, and perhaps taken advantage of CPF investment scheme options in a disciplined way tend to cross that line comfortably. $1 million is rarer still. It usually requires a combination of above-average income sustained over 30 or more years, very limited leakage to property or education, and the full benefit of compounding plus extra interest. The exact percentage who reach 1 million is not published in simple form, but everything we know about the distribution tells us it remains a small minority. Most Singaporeans who hit these higher numbers did not do it by accident. They treated their CPF like the powerful long-term savings vehicle it is, instead of simply letting contributions flow in and out for housing every time income rose. What do these numbers actually buy you? This is the part that matters most. When you turn 55 and set aside the basic retirement sum of $110,200, CPF Life Standard Plan is expected to pay you roughly $950 a month starting at 65, with adjustments for inflation and longevity. Set aside the full retirement sum of $220,400 and the monthly payout rises to around $1,780. Reach the enhanced retirement sum of $440,800 and you are looking at roughly $3,400 or more per month. These are lifetime payouts. They continue even if you live into your 90s. That is the unique strength of the Singapore system compared with many other countries. Yet even the full retirement sum payout, on its own, often falls short of what many people consider a comfortable retirement, once you add healthcare, transport, food, and some leisure. Studies of retiree households show average monthly spending in the range of $1,900 to $2,300 or higher depending on lifestyle. Many Singaporeans therefore need their CPF Life income plus other sources, whether that is supplementary savings outside CPF, SRS, investments, or part-time work, to reach the level of security they want. The good news is that you still have levers even if you are not yet at the higher milestones. The most powerful one is consistent voluntary action on top of the automatic 37% contribution rate for those under 55. Transferring surplus money from the ordinary account to the special account captures a higher interest rate floor and protects it from being used for housing later. Topping up your retirement account directly up to the current enhanced retirement sum when you are 55 or older can significantly increase your CPF Life monthly payout for life. In 2026, there are also targeted government top-ups for eligible members aged 50 and above, with amounts up to $1,500 credited to the retirement or special account depending on your existing savings and property annual value. These are real boosts that compound from the moment they land. Another lever is simply protecting what you already have. Every time you use CPF for housing, you are making a trade-off between owning property today and having more retirement income tomorrow. There is no universally right answer, but being intentional about how much you withdraw and when you refund on sale can shift your outcome by tens or even hundreds of thousands of dollars over a lifetime. The people who reach strong retirement positions in Singapore are rarely the ones who simply waited for the system to do everything. They are the ones who understood the difference between total CPF balance and retirement-ready cash, who moved money to higher interest accounts when they could, who topped up strategically, and who kept housing costs from swallowing too large a share of their long-term savings. They also started early enough for compounding to do the heavy lifting. Someone who begins consistent extra action in their 30s has a dramatically different trajectory from someone who begins in their 50s, even if both end up with similar salaries. So here's the real answer to the question we started with. Hitting $100,000, $500,000, or $1 million in CPF matters, but none of those round numbers by themselves guarantee a secure retirement. What matters most is closing the gap between what the automatic system contributes and what you actively protect, grow, and optimize for the decades after you stop working. The CPF Board data shows us where most people stand at each age. Your own statement tells you where you stand right now. The difference between those two pictures is where your real opportunity lives. Every transfer you make today, every top-up you consider, every housing decision you think through carefully is a move that either widens or narrows that gap. The system gives you powerful tools. How deliberately you use them in the years ahead will determine whether your CPF balance at 65 feels like enough or like the beginning of real financial freedom. If this video helped you look at your own CPF balance with clearer eyes, do me a favor and hit the like button. It helps more Singaporeans find information that can actually change how they plan for retirement. Subscribe to Singapore Finance with Ronny and turn on notifications so you catch every new deep dive into how money works in this country. The more we understand the system, the better decisions we can all make. Thanks for watching. I will see you in the next one.